Hi, I'm Josh Brown. We are live from the compound for a very special edition. I've got Barry Ritholtz with me here today, Michael Batnik, and our friend Allison Shrager. Allison is an economist and wrote the smash hit book. Can we call it that?
Sure.
The smash hit book, An Economist Walks Into a Brothel. I wrote a really great intro, so I'm going to read it right off my sheet. In 2013, Professor Eugene Fama of the University of Chicago and Professor Robert J. Shiller of Yale University shared the Nobel Memorial Prize in Economic Science, and they did enough research into the movement of asset prices like stocks, bonds, real estate, where their contributions to the science, I suppose, were enormous. But they had diametrically opposing views. We're going to talk about how that's possible and how two people could so radically disagree with what moves asset prices up and down and then yet share the same Nobel Prize. Stick around. Let's see what everyone thinks. All right. So first of all, let me just give you a better introduction, Allison. Not only are you an economist and you've worked at investment firms and you've done a lot of other things, but you spent part of your career working directly for Eugene Fama.
I did. For about 2 years, I had a biweekly meeting with him and Ken French and Robert Merton. We debated the future of long-term interest rates.
And what was the result of that debate?
You know, in the beginning, it was to calibrate a model I was working on. In the end, I think they just were enjoying it.
Okay.
Which is why we just kept doing it, because no one knows where they're going.
Okay. So let's get directly into this idea that two people could disagree and share the same prize. I'm fine with it because my own attitude is markets are somewhat efficient, but also driven by emotion. Is that to you? Is that like controversial, or is that what most people believe?
I think that's what most people believe. I think the divide between behavioralists and market efficiency-ish people, regular people, I guess, in economics, isn't, everyone agrees people are irrational and that sometimes that impacts how people behave in markets. But I think the debate is whether or not that actually impacts prices.
Right.
So some trader might be acts irrationally, but does someone else go in and bid prices back to where they should be?
Quick enough so that the market stays efficient.
Yeah, like take the flash crash. Not that that was behavioral, but that was something that happened that shouldn't have happened.
So May 2010, the stock market dropped by like 10% in a day or something.
Faulty algorithm.
Right.
By the end of the day, it was back to where it should be.
But it doesn't have to be faulty algorithms. It could be faulty humans. So when the Cuban news hit with Obama, maybe in 2012 or something like that, there was a closed-end fund with the ticker CUBA that spiked big time. And Thaler and Fama were having a debate about this on a video a few years ago.
Yeah. Oh, so it's a closed-end fund that everyone said, oh, we're going to normalize relationship with Cuba. I need to be invested in Cuba. And they found that ticker and they just bought it.
And it had nothing to do with actually Cuba. So I don't know if that was algorithms. It could have been. And then maybe humans piled on. Who knows?
Right. So not only, it's not an ETF. So when it spiked up, its price was worth more than the actual assets that it held.
Yes, I think there was a significant premium to NAV.
How long did it last?
I think a day or two.
Yeah. So Gene would be like, well, eventually everyone caught on and bid it back to where it should be.
Okay. So let's get into what each of them are saying. So tell me if I have this right or elaborate on this. Eugene Fama is basically saying that as information is disseminated to the public very quickly or quickly enough takes that information and enacts whatever buys and sells they might do on an asset's price. Let's just say the stock market, okay? And so in that world, there's enough efficiency where it would be really hard to be smarter than the market on a regular basis. And the takeaway or the implication of that is most people should be in some sort of an index and not spend their whole time trying to outguess or outthink the market. Is that, like, in a nutshell, what he's saying?
That's excellent. That's a very good summary of it.
And what would you say is, Barry, what would you say is Robert Shiller's counterpoint to that?
So that markets are efficient and they follow a whole set of circumstances for a while, but then when you look at things like the fluctuation in prices of dividend-yielding stocks, you know what the dividend is, you know what's going to be, and yet the range and the volatility in these are so far in excess of what's remotely rational, you have to think people are just not being reasonable. That's before we get to all the work he's done on bubbles, which Fama has never really done a good job explaining bubbles within the context of EMH. And that seems to be the tension between how the two of them won a prize together.
So Mike, you pointed out that one of the things that Shiller did that was cited, I guess, by the committee was looking at dividends and saying there's so much less volatility in things like dividends and earnings than there is in the price of the stocks themselves. So how could you not point to that and say there's a lot of emotion involved in the movement of prices?
Well, if people are discounting future cash flows, what are cash flows that they're actually discounting? It's dividends.
Right.
And to Barry's point and to Schiller's point, the price fluctuates so much greater than the actual dividends do. So how could that be anything other than irrational participants?
Right.
But quickly, also, so Fama was cited as people's inability to predict short-term market movements. And Shiller, on the other hand, somewhat predictability to forecast long-term market movements with things like the CAPE ratio.
So he was saying if you take the cyclically adjusted price-earnings ratio of the market and you look over the long term, it turns out that returns for stocks are higher when you buy into the lower CAPE, even if you have to wait 10 years for that to materialize. So he was able to say, like, how does that translate into markets are wildly inefficient or markets are emotional?
So correct me if I'm wrong, but I think that Fama thinks that all of the available information is reflected pretty immediately in the stock price. He wouldn't say that the stock price is always correct.
No.
He would probably say that you don't know when it's incorrect and you can't consistently profit off of these times.
Yeah, I think that's it. It's just, I mean, this is why efficient markets is infuriatingly simple. And I think this is where a lot of people go wrong because he doesn't believe in bubbles because he doesn't think there's a definition of a bubble. He thinks if it's a bubble, you should be able to predict when it's going to pop.
But why? I don't understand.
Well, because it could be rational. If you think something's overpriced, if you think the stock market's overpriced right now, it could continue to go up for another 5 years.
So he told the New York Times, Fama, I don't even know what a bubble means. These words have become popular. I don't think they have any meaning. He said that in 2010, which took a lot of guts to say given what had gone on in the previous 2 years.
Yeah, I don't think he thinks prices don't get out of whack. I think it's just hard to predict, when and how they're going to change.
But don't you think that he is such an empiricist that maybe bubbles can't be quantified and can't be profited off of consistently with an algorithm? Doesn't mean they don't exist, though.
Well, how do you define bubble?
When stuff becomes so wildly unhinged from a fundamental set.
So he was asked about that question. Cassidy wrote at the New Yorker, did an interview and went to him with all those questions. And he said, this is Fama. Now, after the fact, you always find people who said before the fact that prices are too high. People are always saying that prices are too high. When they turn out to be right, we anoint them. When they turn out to be wrong, we ignore them. They are typically right and wrong about half the time. So in other words, you can always find someone who's saying that such and such asset class, real estate, bonds, stocks are too high, and maybe they'll get it right, and you'll say, look how smart. But like a lot of people just always say that all the time.
Here's the pushback to that, and I have a lot of respect for what he's accomplished and everything behind EMH, but here's where I think he slightly loses the thread. Look at the 82 to 2000 bull market. The 75% of the market gains over that period wasn't due to an increase in earnings. It was due to an increase in stock market multiples, meaning the sentiment had gone from I'm willing to pay X for a dollar of earnings to 4X for a dollar of earnings. That's pure sentiment. And EMH is not picking that up as reflecting information. What they're picking up is what the market's picking up is the change in sentiment. And that's where Shiller's irrational exuberance eventually kicks in at the end of that run.
Right, so in 1982, the stock market's selling at a multiple of 10 times earnings.
Seven,
yeah.
If you go right in the heart of
Nobody wants stocks, and by
32 at the
by the end of that period, it's 32 for the S&P, it's 90 for the Nasdaq, it's
Right.
50 for the Dow. Like people change their mind on the whole asset class because they kept making more money each year. They're willing to pay more.
Meaning it's not, oh, look, all our information about earnings are reflected. It's no, I am now willing to pay much more for the exact same dollar of earnings.
What's the Fama answer to that?
So, I mean, I don't want to speak for him, but
No, it's okay. We couldn't get him, so you can.
I'm sure he'll be thrilled. That, is information just earnings, or could sentiment be like, I have this, sentiment be part of information? Does it have to be stone?
Well, it's certainly informational, but it's the human emotion as reflected in stock prices. So I
Like,
think it's
I
a stretch
know-
to say it's information,
I know Gene doesn't believe in momentum as a factor, but in theory,
despite all the quantitative data about momentum.
I'm not, here to defend everything he thinks, but you could argue with the sentiment thing that there was momentum involved, and therefore that would have been rational.
I would argue definitely there was momentum.
Don't you think that people are too extreme investors, either in one camp or another, where there's a lot that you can learn from both of these gentlemen? And I do think that if you had to pick a side, I think most people are much better off acting as if markets are perfectly efficient, even if we know that they're not.
Absolutely. And also, a lot of Shiller's work is super valuable because we all definitely do all these behaviors. They decided to do this. And we could not only do better as a market as a whole, but do better in our own individual behaviors if we study these things and understand them better.
This is Shiller's quote. He says, "The assertion stock prices were rational was one of the most remarkable errors in the history of economic thought." And then he goes on to say, "Mass psychology may well be the dominant cause of movements in the price of the aggregate stock market." So maybe there's room to say that stock prices, one stock versus another, maybe there's a lot of efficiency there with all the stock picking and all the research that goes into that and how quickly people react. But maybe in the aggregate, like taking an absolute view of the stock market, maybe that's where the irrationality and the inefficiency of the overall level.
Somebody said that markets are micro efficient and macro inefficient. But how many world famous macro funds are there? I mean, it is remarkably hard to do this consistently.
What, to say when the absolute level is too high or too low?
Too high or too low, yeah.
And you would know this better than I am, but are markets getting more efficient with more algorithmic trading?
Theoretically.
I mean, I don't know. I think so.
Again, internally or on the overall value, how can there be an efficient overall level for the market to sell at?
Well, I mean, all these sort of, especially hedge fund guys are saying it's so much harder to make money.
As reflected in their performance.
Yeah.
So the
especially
market has become efficient for expensive
Or it's
macro
become
traders.
or manipulated. A lot of them would say.
So that's all right. So that's an interesting question, because then you can hear from people who say it's less efficient than ever because 40% of the market is now held by index funds. And these are people that are buying the fund, and then the fund is allocating to the stocks, and they're not making any judgment call on the value of each stock. They're just buying the basket in the increments that they currently sell at, like in the weightings that they currently sell at. So there are people that say that's inefficient, and therefore it should be easier for the other 60% of the market to find opportunity, which we know hasn't materialized.
But that other 40% now is algos, and they're not allegedly, although you could argue biases are built into whoever built the algo, not prone to our behavioral foibles or whatever holds us back.
The purchases of indexing purchases of specific stocks, isn't that completely predictable? Why wouldn't the algos or the macro traders be able to game that? You know what the proportions are. You know what the proportions are. You know what the money flows are. That shouldn't be why they're underperforming.
They're actually the market makers for those transactions. Those are the participants in the market that actually form those baskets and sell them back to the fund sponsor.
So 40% of the stock that's being traded is being traded in a very foreseeable, predictable way. Why would that make markets less efficient? If anything, it would make them more efficient.
So the reputation of Robert Shiller's forecasts. So he does a lot of media, and he will point out things that are excessive, which a lot of us could do. And then he'll say, but I own index funds anyway. But he did become very well known for, quote unquote, predicting the dot-com meltdown in 2000. And then he did it again with home prices. But I think in both cases, in one case he was 4 years early. And then in 2005 was when he was really raising the alarm about the home bubble, if you want to call it a bubble, or the credit bubble, or whatever you want to say. But back to Shiller's point, Fama's point, isn't it easy to always do that?
No, like 2 years ago, he said the stock market was overvalued.
He's been doing it for years.
Right.
Yeah.
Stay with the Shiller prediction thing. Him and Richard Thaler were co-presidents of the behavioral economics group of the American Economist Association. And Thaler has very specifically slagged Shiller in terms of how bad his forecasts are. He just makes them over and over again very nicely until he's eventually right. 96, I think. No, the speech was 96. I think the book was
The book
a
might
little
have
after
been, the
that.
book might have been closer to the top.
Was I think they took the name of the book from Greenspan said in Rush. Now Greenspan said that in 96 and it was 4 years to the top.
Right. And I think Greenspan pulled the term from a presentation that Shiller had given the Fed.
So one of the other things that always happens when market people are chattering and somebody says markets are inefficient, it's almost an affront to their career and their way of life. So they ridicule it, and they and I'm one of them. but we pile up all these examples that we can break out like a trump card, like, oh yeah, markets are efficient.
Yeah, how Beyond Meat or Tilray.
No, even like in 1999, 3Com was this networking company that owned Palm Pilot.
That's right.
Palm Inc. And they spun it off, and for like a considerable period of time.
Before the spin out.
No, they did like 10% of Palm as an IPO, and then they were going to distribute the other 90% to 3Com shareholders. I was involved in that. Like, we were pitching that to retail clients, buy 3Com because you're going to get Palm spun off.
Explain the valuation.
Oh, so
issue.
what happened was, for a period of time, Palm was trading by itself, 10% of it, and that 10% became worth more than all of 3Com, even though 3Com owned the other 90%. I'm not saying that went on for 6 months, but it might have been 3 months.
So here's the takeaway.
And that's one example of like 700 that people have.
Yeah, but that's availability bias. Like, you remember those.
But it's also a tangible example of a huge inefficiency that if we were so efficient, it would have been wrung out before it could.
So here's the takeaway. Markets aren't perfectly efficient. They're mostly kind of, sort of, eventually
Wow, where's your
efficient.
Nobel Prize for that?
I
Is
don't know.
your
That was
theory?
a blog post. I just got a few page views on it, but that's that.
If this were a spectrum and Shiller's at this end, and he doesn't give an inch, by the way, which is what I love about him. Like, he doesn't do nuance. He's like, there was no such thing as a bubble, right? Fama, excuse me. He basically said there was a recession that caused the financial crisis, not the price of assets.
So what would he say about Tokyo real estate? Wasn't it the Imperial Palace was worth more than all the real estate in the United States at one point?
That
or something like
Shiller
that?
said that.
No, but what would Fama say to that? How is that not a bubble?
Well, he doesn't mean that the prices are right. It just means that there's no way to predict when they're going to be wrong.
So there's no difference between expensive, and Ben Carlson did a post on how much different the Japanese bubble of the 80s was relative to the NASDAQ bubble. It was like 5x the NASDAQ bubble. Yeah. And it was, people say, how we're turning into Japan. No, you have to understand how insane and unhinged their prices were for real estate, for stocks, for bonds. Everything had.
Patrick O'Shaughnessy gave a great example in his book about it. If to put this into context, if somebody a kid had a lemonade stand and they were doing like $50 in annual profits, the company would be worth $5 million. It was something like that, something so outrageous.
So all right, so there's a spectrum, and at one end is Shiller. Markets are driven by emotion. Bubbles happen all the time. And then at the other end is Fama, basically saying, no, people are paying what they think something's worth at that moment, and then that changes. And that's why prices change. Like, which end are you closer to?
Closer to Fama, but not entirely there.
Okay.
I would say if it's here, I'm like here.
You're 60% of the way to Fama.
60 to 70, depending on the day.
Do you remember when we were in Austin and we were there for a DFA presentation?
I know exactly what you're going to say.
And so it's a room full of financial advisors, and it's like 2014, and like the Fed is like the biggest story in the markets. And somebody asked a question about the Fed or where interest rates going to go, and his response was, so Fama was on a big screen from Chicago. He wasn't there in person, but he was taking Q&A, and his statement was, I forget the exact words, but he goes, the Fed doesn't decide interest rates.
He literally laughed.
And he started laughing. Like, you know that laugh that he does?
Oh, is it? I did.
He makes himself, he thinks something in his head, and then he starts laughing.
He he laughs to himself. And I spent, 2 years debating where interest rates are going with him.
Which interest rates were you debating, by the way?
Long end of the curve?
Which is driven by the bond market, not by the Federal Reserve, so he's right.
Yeah, so although I remember at one point I was getting, my calibrations weren't converging, and I was like, it's because of QE. These aren't market prices. And then he shut down that conversation. He's like, you're wrong.
What was his answer to the QE and how that affected it?
He said I was wrong, but then he went on CNBC a couple weeks later and said that QE was messing with prices. So I'm going to take that as a victory.
So he doesn't accept that there was a bubble that caused the financial crisis. And what he's basically saying is that there was government policy that forced Fannie and Freddie to get very involved in making it so that buying a home was easier and more affordable, and that changed the dynamic of the market. And then he says it's not that prices for assets started to fall and then we had a recession. He's saying there was a recession, so people stopped paying mortgages, and then prices fell.
You know, a lot of what he said has been debunked. The housing boom and bust was global. Look at Europe, look around the world. That it wasn't Fannie and Freddie, that it was Fannie and Freddie aren't going to affect Ireland or Iceland home prices.
But that's his point. He said the big surprise and what made that recession different was that it was global, and you never had a globally coordinated housing boom and bust before.
Therefore, it had to be driven by ultra-low interest rates and easy availability of credit, primarily from the private mortgage underwriters and the entire securitization industry.
I guess when he's saying it's not the bubble that causes it, it's people stop paying their mortgages, which forces all these bonds that were based on mortgages to fall in value, which then triggers markets to sell off. But that's caused by selling. People don't wake up one morning and say, we're not going to pay our mortgage today. There's an economic issue that forces them.
Well, when interest rates go from 2 to 11, they do.
It actually, he's got it backwards because housing peaked in 05, 06 and started rolling over. The stock market didn't peak till October 07, and the recession didn't begin till December 07. Housing was already deep.
Why did it peak? Why did it peak? Why did people one day say that $1 million house, you know what? I'm going to pay $990,000 for it instead, and then the seller accepts it. What is the process by which that
tons of people
all of a
had
sudden
the
occurs?
228 mortgages that reset. The circa 05, 06, 07 batch of mortgages were resetting in 07, 08, 09, and when they began to reset and it went from these low teaser rates to these bigger rates, especially in non-recourse states where you can walk away without penalty, people walked away, and that's why the defaults started. The defaults preceded the market peak and the recession.
So the recession did not cause the defaults.
No, it's backwards. This was a backwards real estate-driven economy. It took the markets up post-bubble in 9/11, and it took them back down. Remember, home builders were crashing in 05. The banks and the mortgage underwriters were in trouble in 06. By the time you got into 07, the money center banks and the brokers were running into trouble.
Ritholtz to Fama scale, I'm all Ritholtz on this one.
And Ritholtz would be where Shiller is, essentially. There were emotional home buying purchase. People wanted to trade up.
Give people free money, and guess what? They're going to take it. My favorite scene in The Big Short is he's talking to the stripper about the home that she bought, and he said, that is my favorite scene because he says to her, the Steve Carell character says, you bought a home on a variable mortgage with no money down? And she says, a home, I have 7 of them. And that's when the light bulb goes off and, hey, this whole thing is going to collapse.
What's your take on the crisis and the causes?
I think there's a lot of them. I mean, I know that sounds like a cop-out.
No, I think we all agree.
Yeah, I think, there was a combination of too easy money. There was a combination of bad judgment, government interference. I think it was just a witch's brew of everything went wrong.
Right. So the search for what's the one reason for why there's a stock market bubble or a real estate crash or what it's probably never one answer.
Exactly. I mean, it's like, why have interest rates been trending low for so long?
So why are interest rates trending low for so long? So here's an example of you would say that there's emotion involved because people just want safety at any cost, and in Germany they're willing to give up a quarter of a point to own government debt rather than risk it.
Well, is that irrational? I mean, if people crave safety, they want safety. Or you have all these large sovereign funds who want safe government bonds for whatever reason.
They need liquidity.
Yeah.
Is there a shortage of quality sovereign bonds? It seems if there were more of them, rates wouldn't be as low as they are.
I don't know if it's a shortage, but it's made them very expensive.
$55 trillion in sovereign bonds, $20 trillion is negative yielding.
So double that, and you'll get rid of the negative yielding bonds.
That seems irrational to me.
That
That doesn't seem efficient to me.
we went through a long
And it's
period
gone on
of
for 5 years.
We
4
went through a
years.
long period of time where we weren't deficit spending. We were running moderate budgets. And now that's starting to end.
I understand there are macroeconomic reasons. I'm just referring to whether or not it's rational or it's efficient.
You think people are paying too much for safety?
Yeah, I mean, isn't it obvious that they have been?
Wouldn't Fama say that sometimes people overpay? But I guess, again, it's just like, can you identify when they're overpaying and can you profit off it? And probably the answer is no, you cannot.
We've been waiting for bond yields to go up for like 15 years now?
They were in a bubble in 2011.
All right, so it seems like we've solved this. Markets are mostly efficient, but periodically prone to emotional actions by market participants, and so there's irrational exuberance too. Thanks for tuning in. Let us know what your thoughts are. Are markets efficient, or do human emotions dominate the ups and downs of asset prices? Let us know what you think. We love your feedback. Go ahead and smash that like button for us. Subscribe to the channel if you are not already subscribed, and we will talk to you soon.